pay the charge, that's not interest, and that's any account. I want you to read I'm gonna read this one more time, and then I want you to think of every account you got. Every account. You know what I'm saying? Every account, because every account we're dealing with debits and credits on every account. And once you start understanding what I'm really trying to show you in a bigger sense, instead of just debit and credit card, you understand what I'm showing you, right? Now, interest, we're going to read it again with respects to a deposit. Now, we're dealing with debits and credits. We're dealing with debits and credits. Now, when you think of debit card, credit card, you can't just think of in the sense of just cards, so to speak, but more or less like agreements or something that allows you a right to something, to receive a certain value of something, whether it's a whatever kind of agreement, card or whatever it is, device, however you want to see it. So let's read it again. Interest with respects to a deposit, when we talk about a deposit, means any payment to or for the account of any depositor. So whenever you make a deposit, anytime you receive a payment to that account for that deposit, or a payment for that deposit to your account as compensation for the use of funds constituting a deposit, that's when you've actually received compensation. That's when your account, when you know, this is what you're supposed to be. This is the key. This is what we're trying to get the bank to actually do what it's supposed to do. But first, you got to know what the rules are in order to, and then you can use that debit card the way you want to use it for any type of transaction. All right. Insured depository is, let me see. So a bank absorption of expenses include an incident to providing a normal banking function or is forbearance from charging a fee in connection with such a service. So whenever the bank provides you any service, whether it's an EFT, whether it's an ACH transfer, whether, I don't care what kind of service it is, they're not supposed to charge you for that, right? Right? They ain't not supposed to charge it. It is considered a payment of interest. It is not considered a payment interest. If they ever charge you a fee, it's not considered a payment of interest. So that always goes against you. You should always receive your rights to interest. See, and then in this, it says that a natural person means a human being. So it's being specific. All right, so non-contingent trust interest means a trust interest comparable of determination without evaluation of contingencies, except for those covered by present worth tables of rules of calculation for their use set forth, and then it gives you the state tax regulations and things like that, right? And then it talks about the sole proprietorship. I'm gonna try to skip through it a little bit, right? And tell you what that is, and then the standard max deposit insurance amount. So it tell you what the max amount is that they allow to, you know, to issue is pretty much is 25,000. Like we all know that bank accounts, but if you are the issuer of everything that you have, then you issued that 25,000, and you should be able to be compensated for that. Whenever you know, if you are the one that's issuing the insurance, then you should always be compensated. Now, trust estate, it's mighty funny that it's calling it a trust estate. I want y'all to pay close attention that it's recognizing a trust estate. Means the determinable and beneficial interest of a beneficiary or principal in trust fund, but does not include the beneficial interest of an heir or device in a decedent's estate. So it's talking about, you know, your direct interest, right? And then it talks about, I skip past that, but then it talks about trust interest means the interest of a beneficiary in an irrevocable express trust other than an employee benefits plan, created either by a written trust instrument or by statute, but does not include any interest retained by the seller, right? So what it's saying is, it's saying that the trust interest is like any interest, whether it's irrevocable in any agreement. See, we got to understand that a trust is just an agreement. And everything we do, we create agreements with other parties to do certain things for us, which is a trust. So everything, you are the grantor of all your own trust, but if you're not recognizing the trust. So that's why I'm trying to show you, like, you know, how this is working and things like that. So you can understand that the interest is what you're entitled to from, you know, utilizing the trust. So let me pull this other part up real quick so I can talk about this government-wide purchase card. Yeah, I go check that out because I kind of just breezed through it a little bit, but it's a lot of great information in there that I didn't even get to, you know. But I just want to expose you. So a lot of people don't even know where to even read concerning depository insurance. So I'm really showing you Jews, because that's dealing with the bank, and the bank is the source of everything. Everything you're trying to do, pretty much you can do it all through the bank. So I'm showing you the laws so you can actually go back and you go eat that up, what I just showed you, dealing with depository insurance and getting the proper understanding of how deposits work, what the bank is supposed to be paying to you. I'm showing you some fire stuff that a lot of people will charge you thousands to even know, for real, because they realize the importance of the information and your ability to have it, to actually learn it, you know. And then you will understand like why you can do certain things with your debit card and things like that once you understand about your account being insured already and your rights to have certain things done. All right. Let me pull it up. 1026. All right, so we're reading from 12 CFR, part 1026. This is Regulation Z. Talking about limitations, talking about cards, debit, credit card limitations, percentages, things like that. So, like I say though, this is a lot of information. You got to really study, man. It ain't something that you're gonna just breeze through. You got to really go back through this stuff that I'm showing you. You're gonna have to read, because I'm gonna skip a lot of stuff just to get, you know, to the most important parts of this. All right, so except as provided in paragraph 2 of this section, the total amount of fees a consumer is required to pay with respects to a credit card account under open end, not home secured consumer credit planning during the first year after the account opening must not exceed 25% of the credit limit in effect when the account is open. So you can't exceed 25% of what the account was worth in credit at the time it was open. For the purposes of this paragraph, an account is considered open no earlier than the date on which the account may first be used by the consumer to engage in a transaction. So from the date that the account is open, from the first time you're able to use the account, right? Now, these are rules that a lot of people don't even know, but you got to know these rules, right? In order for you to understand how your card works. So let's read this, right? So the 25% limit in 1026.52A1 applies to fees that the card issuer charges to an account, as well as to fees that the card issuer requires the consumer to pay with respects to an account through other means, such as through a payment from the consumer's asset account, including a prepaid account, as defined in 1026.61, to the card issuer, or from another credit account provided by the card issuer, for example. And then it gives you an example. A lot of people don't even know about the sub account. They don't even know about the Social Security account being connected to your bank account as a sub account, which you can do like what they call overdraft. So when you're overdrafting, that's actually what you're doing. You're actually drawing on your credit account and they charge you for it because it's connected as an extent. So there's certain things that can be done, but people don't know about it. They just keep getting charged, not really understanding what's actually happening. So you gotta actually kind of like know what's going on. All right. Assume that under the terms of a credit card account, a consumer is required to pay $120 in fees for insurance or availability of credit at account opening. The consumer is required to pay a cash advance fee that is equal to 5% of the cash advance and a late payment fee of $15 if the required minimum periodic payment is not received by the payment due date, which is 25 25th of, which is the 25th of the month at the cost opening on January the 1st of the year one. The credit limit for the account is 500. Section 1026.52.A1 permits the card issuer to charge the account to the account the 120 in fees for the insurance or availability of credit at the account opening on February the 1st of the year one. The consumer uses the card account for a $100 cash advance. Section 1026.52.A1 permits the card issuer to charge a $5 cash advance fee to the account on March 26th of the year one. The card issuer has not received the consumer required minimum periodic payment. And then it says, so it's talking about how it's talking about charging the debit card. All right, it's a difference in charging the card versus like doing just a regular transfer or electronic transfer. See, it's talking about charging, and you allowing somebody else to charge your card. All right, which is a different type of transaction. Let me go down. Let me go down past this real quick because it's a lot to read, y'all. So I don't want to try increasing the credit limit. Like I said, I got to go around all of this just to get to the main stuff. And all this is dealing with the card. Everything is dealing with the card. Yeah. All right, so everything, we're on the government website now. So where we at is we're dealing with the Equal Credit Opportunity Act. But we're gonna deal with Let's see. Is that the right part? Let me see. 65. Oh, let me read it from what I want to. All right. All right, here we go. All right, so this is what I was looking for. This is 1, I need to be at 2. This is 1. 1 is just dealing with the definitions and everything. But it's a lot of information in here. This is actually where the sauce is at right here. When you come on this website and you come here, this is where it's at 51.1. Let me see, 0.2. All right, so this is what I was looking for. And there's a lot of information on this website. Like I've learned so much from coming here. That's how I learned how to do so much stuff just by reading on this website. So this is the Consumer Financial Protection Bureau. And this one right here is dealing with limitations on fees, right? It's dealing with accounts, like when you opening up in the credit accounts and things like that. So like I said, I'm gonna skip down some, like I said, because it's for the sake of time. So right here is where it started coming in, where you deal with the requirements for over the limit transactions. All right, so the definitions for the purposes of this section, the term over the limit transaction means any extension of credit by a card issuer to complete a transaction that causes a consumer credit card account balance to exceed the credit limit, right? Opt-in requirements. General, a card issuer shall not assess a fee or a charge on the consumer credit card account under open-end, not home secured consumer credit plan for an over-the-limit transaction unless the card issuer, 1, provides the consumer with an oral, written, or electronic notice segregated from all of the other information describing the consumer's rights to affirmly consent or opt in to the card issuer's payment of and over the limit transaction, provide a reasonable opportunity for the consumer to affirmly consent or opt in the card issuer's payment over the limit transaction, provide the consumer with confirmation that of the consumer's consent in writing, or if the consumer agrees electronically, or provide the consumer with notice in writing of the rights to revoke that consent following the assessment of the over the limit fee or charge. Completion of an over the limit transaction without the consumer's consent, notwithstanding the absence of the consumer affirmative consent under paragraph B1 of this section, the card issuer may pay an over the limit transaction on the consumer account, provided that the card issuer does not impose a fee or a charge on the account for paying that over the limit transaction. So, you know, and Chase is good at that too, where you can actually set it up to where, you know, you can agree to where they'll overdraft or pay any amount or whatever. You just got to know how to repay back the loan or whatever, you know what I'm saying, if that be the case. All right. So it says method of election. A card issuer may permit a consumer to consent to the card issuer payment of an over-the-limit transaction in writing, orally, or electronically at the card issuer's option. The card issuer must also permit the consumer to revoke his or her consent using the same methods available to the consumer for providing consent. Time and placement of notices, initial notice, general